Good morning, Mr. Carfang.
Thank you, Chairman Garrett, Ranking Member Maloney, and members of the committee. My name is Tony Carfang, and I'm a partner with Treasury Strategies. We're a consulting firm that specializes in treasury management, payments, and liquidity. I'm here today on behalf of our several hundred clients, businesses, state and local governments, financial institutions, hospitals, and universities who are active participants in the capital markets and rely on fixed income and securitization for their short-term capital requirements. Our American capital markets are the broadest and deepest and most robust in the world, and we applaud all of the work that's been done since the financial crisis to make them safe and to help keep them that way. Unfortunately, many of the regulations, which in isolation further specific objectives, in combination, we're now seeing as they're beginning to be implemented, are causing some toxic interaction. In some sense, and in some parts of the market, it's kind of like a high school chemistry experiment gone awry. When we put all these things in the same tube, you know, all sorts of things are happening here, and some parts of the market are being clogged and choked. Now, we applaud your efforts in considering the three bills that are under consideration today. And what I'd like to do is sort of set a context for what is happening in the capital markets as a result of this chemical interaction, which argues for the need for specific items of relief. Now, I'd like to say a word about risk retention. As all of our clients know, risk can neither be created nor destroyed. It can only be transformed, it can only be shifted. And to think that risk retention in and of itself will eliminate risk is kind of like thinking that car insurance will make you a better driver. It doesn't happen, it just shifts the responsibility to someone else. Now, how do we know that this chemical reaction has gone awry? Well, let me state a couple of things that we see in our consulting practice and our clients are struggling with every day. Since the regulations following the financial crisis have begun to take shape, there are 1,460 fewer banks in the United States than there were in 2010. That's a 20% decline. And that means that capital formation, particularly for small businesses and municipalities, is bottlenecked. There's less choice, there's less opportunity. In the 80 years that the FDIC has been chartering banks, in the United States we've created about 150 new banks each and every year, going back through the 1930s. In 2010, only five new banks were chartered, and in the 5 years since 2010, a grand total of only 2 additional banks have been chartered. So we're not getting the innovation, we're not getting the robust formation at the bottom of the pyramid, which we all need. I'd like to turn our attention to money market funds in particular. Prime money market funds provide the short-term capital for businesses and for financial institutions. They buy their short-term paper. Prime money market funds are the subject of an SEC regulation designed to take in effect in October. And since the regulation was announced, 56 prime money market funds have converted to government money market funds, which means that about $264 billion that used to be lent to U.S. businesses and financial institutions are now tucked away in government securities. That money has been removed from the private economy. Now, one particular item of concern is the tax-exempt money fund market, which municipalities rely on for their infrastructure improvements, for their schools, their roads, their hospitals, college dormitories, and whatever. Since the enactment of the regulation, in my testimony when I wrote this last week, I said that 27 tax-exempt money market funds have been closed, and as a result, some municipalities and state governments will not get the financing that they need. Since then, in just 1 week, that 27 has grown to 45. And just this morning, there were announcements of closures of tax-exempt funds that specifically service Massachusetts, New York, and California municipalities. So we have a serious problem here. Mr. Chairman, you mentioned Basel III and the alphabet soup. the HQLA and all these capital requirements, what that does is it impairs the bank's ability to lend and sends investors off the grid. So in conclusion, I want to say that these regulations have stranded quite a bit of capital, and we need to put those back into the productive economy, and the three pieces of legislation you're considering today are a great step toward that end.
In the right direction.
Thank you very much.
Mr. Carfang, I only have a few minutes. Can you say this in your testimony? The combination of the Volcker Rule and increased capital requirements results in financial institutions scaling back their market-making activities. This results in wider bid-ask spreads, and ultimately, too, less liquidity in the market. Is that true, what you said there?
Yeah, absolutely, sir. In terms of putting this in context, the macro statistics belie what's actually happening in the economy. Yes, there are $1.5 trillion of new loans, but they are going only to the largest and most creditworthy borrowers and not the mainstream businesses or municipalities.
And is it true also, as you said, that there have been sporadic liquidity black holes in which when the markets completely freeze up or prices gyrate widely since that time?
Absolutely. We had the U.S. Treasury flash crash about a year ago, and several other pockets where securities could not be sold at any price, albeit for short periods of time, but liquidity means it's there when you need it.
Sounds like a problem to me. Thank you.
On market and the impact that post-crisis regulations, Dodd-Frank, et cetera, have had in what many are very concerned about, and Mr. Green has talked about that specifically. And I think it's interesting also that we've had certainly witnesses who've testified before this committee that have just said basically nothing to see here, let's move on when it comes to this concern. And so I wanted to ask Mr. Carfang first, and sort of following up more particularly about the corporate bond market and the liquidity concerns there. And if you could respond directly to what Mr. Green has laid out in terms of whether or not we should be concerned about this liquidity, and as it specifically as it relates to the things that you have laid out in your testimony that suggest otherwise. And then I would like to hear from Mr. Plunkett on this as well when you're finished.
Sure. Mr. Green's facts are correct. His conclusions are wrong. We have
Can you explain that more?
We have a Federal Reserve that has inflated its own balance sheet from $1 trillion to $4 trillion over the course of the financial crisis. That completely disrupts the financial markets in a way that reduces interest rates. So when Mr. Green says borrowing costs are an all-time low, well, yes, but that's Fed-induced, not market-induced. When the Fed unwinds its balance sheet, frankly, no one knows. That's going to be another chemical put into the experiment. Our clients, particularly those who are not of the highest credit rating, are having difficulty raising cash or raising cash at rates that make sense for them to create jobs and expand their businesses. That's true for our corporate clients. That's true for municipalities and state governments as well.
Do you think that if the Federal Reserve raises rates in the future, that will exacerbate this problem? And where does systemic risk fit into all of this?
Well, I'm not sure that it will exacerbate the problem. I think if the Fed allows rates to settle where they would naturally settle in the marketplace, we would have the most optimal results.
Okay, Mr. Plunkett, love to get your thoughts on this.
I'm not prepared to speak in any detail on this subject, but we do hear from our asset management firms that the liquidity in the fixed income market has certainly changed. Not for the better. The one point I might add is that when we talk about the amount of corporate bond issuances, it might be linked to the fact that investors are searching for yield, and it's a zero interest rate environment. So, companies are certainly going to go out and tap that zero interest rate environment as much as they can.
Thank you. Mr. Duffy, recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Carfang, what role did prop trading have in the financial crisis?
Banks trade for their own portfolios, And they do that primarily to accommodate their customer activity as well as profit themselves.
Was it a root cause of the financial crisis?
Absolutely not.
I would agree. So would you agree that Volcker caused a reduction of providers and sources of liquidity in fixed income securities?
Right. I believe the Volcker rule has caused less trading and therefore wider spreads.
And so now where does that new liquidity come from?
Well, the liquidity comes from banks, and it comes from all the participants in the capital market.
Maybe this is to Ms. Coffey as well. Do you guys, either of you, see any additional downside risk with these new liquidity providers at times of market stress?
I mean, absolutely. One of the things that you need to think about is, do you have two-way liquidity or do you have one-way liquidity? What's very important with market makers is they provide two-way liquidity. They will buy and they will sell. When you have many market participants, they might all be buying or all be selling at the same time, and that is something very important to bear in mind.
Okay, and Mr. Carfang, I think you made an interesting point in regard to the high school chemistry set. You might see one potion or powder and how that behaves in its vial by itself, but when you put all three vials together, we actually don't know what happens. So if you look at risk retention, Basel, and Volcker, do we actually know the consequence on our markets with these three combined?
Well, and what we're seeing when these three combined is those institutions of the absolute highest quality have liquidity, they have low spreads, they have inventories, they have traders in their securities, but everyone else is being crowded out.
Yeah.
All but the highest quality borrowers, have access now. We see, Basel III is what we refer to as being pro-cyclical. So when things are fine and markets are not in stress, there's plenty of capital, there's low rates, low spreads. But in times of stress, Basel III actually requires banks to hold more liquidity, more treasury bills. And we actually foresee what could be a hoarding and a real collateral crisis when we do have markets in greater stress. We don't know. We haven't seen how the markets and how this chemical reaction is going to take place when you add financial stress, you add the Fed unwind, and a number of unknowns that are still playing out.
Have we seen any warning signs with whether we look back to October or to August of this past year, where we have any market stress and what happens to liquidity?
Well, we had the Treasury flash crash. We're also seeing pockets of illiquidity in the municipal bond market from time to time. We're seeing trading gaps because of very high volatility. Big fluctuations in price are the result of low inventories and wide spreads.
So you guys are all aware of Lord Hill, Jonathan Hill from the EU, and they've actually taken a pause or recommended a pause in the EU because I think there's an understanding that we don't know, like your chemistry set, the consequences on our markets, on our economy, on our growth, that all of these rules are going to have on one another. Is there something that we know on why all these rules are going to work that the Europeans don't know? Or is there something they know that we don't know?
Well, in the early part of the decade after the crisis, there was a regulatory arms race. Other central banks are taking a pause. We are not. Many of the regulations are actually improving the safety and soundness of the system. I'm not here to advocate that these regulations be ripped apart, but it's that chemical reaction that we haven't taken a deep breath, we haven't stepped back to understand what all these unintended consequences are. When a municipality can't sell a note to a money market fund to meet a payroll, that's a problem.
Ms. Coffey, would you agree that we don't know the consequence in times of market stress, how all of these rules are going to impact our
Absolutely.
markets?
I'd say there are more than 3 chemicals, and I certainly hope nobody blows up the school.
Is it possible the school gets blown up here?
I certainly hope not. But I think there are definitely questions that when you start layering all these different factors on top of each other, nobody knows how it turns out.
At the margin, behavior changes. And yes, there will be a school that's not built. There will be a hospital that's not built.
Chair now recognizes Mr. Poliquin for a period of 5 minutes.
Thank you, Mr. Chair, very much. I appreciate it, and thank you all very much for coming here today. This is a really important education for a lot of us. Everybody in government should do everything humanly possible to help our companies grow, whether here in Washington or in state or the local government, right? I mean, we're all here to help. And when you have companies that are able to grow and hire more workers and pay their workers more money, you have less people dependent on the government. And I come from Maine. I mean, we're pretty tough and resilient up there. And I mean the real Maine, western, northern, central, and down east Maine, not northern Massachusetts. I mean the real Maine. And we like to consider ourselves independent. So I'm looking at this whole problem of liquidity and volatility in the financial markets, in particular the fixed income market. And when you have lots of volatility with wide price swings, probably brought on, I would argue brought on, by a lack of liquidity in the market because of these smothering financial regulations, does two things. First of all, companies who decide to access the capital markets to borrow by selling bonds so they can grow and hire more workers instead of borrowing from a bank or a credit union, well, they have less opportunity to do that. So there's less opportunity to grow and for our economy to grow. And also for our seniors who are using fixed income investments as a stability against an equity portfolio, they get discouraged also. So my question to you is the following, and Mr. Carfang, I'd like to address this to you. I'm looking at FSOC. Now, this is a group of regulators. Some of the biggest, heaviest, most in-the-weeds regulators we have in the world are on this board. And they pick apart all the different players in the asset management space, all the different players in the insurance space. And they say, you know, are these folks too big to fail? I came from the money management business. Now, I'll tell you, if you and I are competing and you're managing pension funds and I'm managing pension funds and my performance is better than yours, then your clients are going to come to me, and if you get in trouble, you represent absolutely no systemic risk to the market because the assets are held at a custodian bank. We're agents. What systemic risk do we provide to the economy or to the capital markets? We don't. Now, I'm looking at this whole thing that FSOC's doing. Why in the world shouldn't they be spending their time looking at fixed income market risk? When you have less liquidity in the fixed income market, isn't that systemically risky to the economy and to the financial markets and our ability to grow as a country and provide more opportunities for people? What do you think of that, sir?
I think the FSOC actually creates double jeopardy and creates a culture of indecision on the part of our financial institutions and the investors. Financial institutions are not only subject to their specific regulators, but should FSOC not like the outcome that the regulator has, they have a second bite at the apple. And that absolutely slows down creativity, it slows down economic activity, job creation. To me, the FSOC is probably one of the most serious problems that we have in the sense that they're overreaching now into asset management and things that have absolutely nothing to do with truly systemic risk.
Why doesn't the SEC focus on that? The SEC's been overseeing asset managers for 80 years. They do a pretty good job, don't they?
Well, they have a tremendous track record. The SEC, in fact, was working on money market fund regulation that I spoke to in my testimony, and was ultimately sort of strong-armed by FSOC into coming up with the regulations that are now damaging the tax-exempt and prime markets.
Thank you, Mr. Carfang.
Mr. Carfang, if I can address some questions to you. And I think if I understand it correctly, you're visiting us from Chicago today, so glad you're here and glad you didn't get hit by the weather going through Chicago. Hopefully we'll all be able to make it back later this week. But I know you mentioned earlier today that the municipal securities market has seen some liquidity challenges recently. What do you see as the major causes?
I think the money market fund regulations, which are being phased in now through October, are causing investors to withdraw assets. In the tax-exempt market, for example, institutional money market funds have to move to a fluctuating net asset value and are subject to fees and gates and are limited to what the SEC defines as non-natural persons. Most banks have to stand on their heads to figure out what a non-natural person is and reclassify accounts. They're simply not doing that and withdrawing the funds. 45 funds have already closed.
Mr. Carfang, could you explain how the Volcker Rule impacted the cost of hedging risk and what consequences this would have for businesses and other customers of banks?
Okay, well, the Volcker Rule and the prohibition of proprietary trading reduces volumes and reduces the size of dealer inventories, which increases the spreads. Those wider spreads, when a farmer is trying to hedge a product, they're paying a higher cost. And what will happen is, at the margin, there will, some will make decisions to actually go naked and not hedge, to take the risk themselves. When the risks are centralized, through clearinghouses or within banks, they're very visible. They can be quantified, they can be managed. When the risks are dispersed through hundreds of farms or co-ops or thousands or whatever, the risks fall in the hands of those probably least able to understand and have market access to manage them.
For that. And Mr. Carfang, I've got a question on the Volcker Rule. Do you believe the Volcker Rule is driving part of our liquidity problems that people are talking about a lot in the marketplace?
Oh, absolutely. It's causing dealers to not be as active in the marketplace. Many dealers are actually now focusing on fewer markets. So you have market makers that used to be very broad and make markets in a lot of debt securities and fixed income products, are now specializing in just a few, which then makes all the participants beholden to just a few market makers in every security. That's risky.
And what does that mean for investors and anybody that has to access the market by buying and selling securities, bonds, or anything that
Well,
they're trying to get?
it generally means either higher cost or lack of supply, lack of access to the market completely.
And can it mean, basically means both or some combination of the two?
Oh, generally it is a combination of the two.
And there's been a PwC study that talked about the regulatory impacts that were helping create this liquidity problem. Have you seen any other studies with similar conclusions?
Well, the U.S. Treasury itself, through its Tayback report, actually talks about collateral scarcity and the fact that when you add up the collateral requirements in terms of HQLA, liquidity buffers in money market funds, capital buffers in banks across the board, the sum of the requirements for high-quality liquid assets basically consumes all high-quality liquid assets in the marketplace. So you've really put a binding constraint on economic activity.
If you were advising the FSOC or the Office of Financial Research, do you think this is a subject they should look into?
Absolutely. Short of their own dissolution, this is one of the most important things.